Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It is Monday morning, August 28th. And so far, the futures market in the U.S. is in the green. The 10-year Treasury yield, helping the futures market, is below 4.3%. Now, please keep your eye on that this week, because this week we actually have a host of important data releases regarding the economy, regarding inflation. So what we want to pay attention to is how does the 10-year Treasury yield respond to the economic data. Let me make something very clear. It isn't just about economic data that has been moving the 10-year Treasury yield. It is also the fact that the Treasury Department has had to issue more debt because they've got to pay their bills, right? They've got to pay off their bills. And as a result, the initial amount that they were going to bring to market in terms of auctions was just simply not enough. It was under $800 billion. And then an announcement came that they had to go above $1 trillion in terms of auctions. That got the market concerned, and the worry was that on the long end of the yield curve, right, on the very long end, the 30-year, perhaps the 20-year, but the 30-year, that you'd have to offer more in order to bring in buyers. So this is also important. It's another issue for the treasury market. So you have that, but you also, again, have the economic data, which, by the way, so far it's been trending upward. And therefore, the concern is in the market that the Fed may just have to raise rates yet again. We'll get to that in a minute. But at the press conference, or not the press conference, but the Jackson Hole, Wyoming meeting, especially Friday morning, 10 o'clock a.m. Eastern, as Powell was speaking, it was interesting. He basically, there were no surprises. The only surprise I actually heard was that he introduced a new word, which I kind of like. He said the Fed is agile. Right, and that's exactly right. The Fed really is data dependent. I think the market believed him because what happened was we didn't see a huge bounce in the Treasury yields. We didn't see the market sell off. No, it did not. The market, the equity market, actually, said, okay, we understand it. It was the Fed telling us they are going to be extremely data dependent. They're going to be agile. They're waiting to see if, in fact, core inflation. He even broke that down. I mean, it was like a lesson in Fed think. You know, we always talk about Fed speak. This was almost Fed think. How is the Fed thinking? And he mentioned core, and he broke it down even more, and he said, we've got to keep our eye on that. Now, I want to mention, too, that the Fed funds futures market basically does not see a rate hike for the September meeting, and he essentially telegraphed that. For the November and December meetings, the Fed funds futures market is now looking perhaps at just a chance above 50% chance. So that's not definitive, and so much is going to depend on what the Fed says, but also the data. And that's going to be really important, especially from the inflation-related data. So the market actually, how do I say this, absorbed what he had to say. There were no surprises. And I want to repeat, the market took him at his word. The Fed is data dependent, but he made it really clear that if they need to raise rates, they're going to do it. So he didn't declare victory, but he made it clear if they have to go and raise rates again, they absolutely will do it. In any case, this week is going to be extremely important for the market. August seasonality has taken hold. You could see it in the overall pattern of the equity market. And, it's choppy. It's choppy. August, by the way, has the worst reputation in terms of seasonality. people ask, how is that possible? Isn't that when people go on vacation in Europe, they go on holiday around the world, they're all just, taking up. But the thing is, you don't have as much volume in markets, and that can skew markets in one direction or another. So if people aren't focused on the market, or portfolio managers are away, currency markets and so on, anything can skew the market in one direction or another. When you have a full volume, it's more difficult to do that. But in any case, what we're looking for right now are catalysts which perhaps can underpin the market, or, if they disappoint, could cause the market to sell off even more. We expect to see probably more chop, again, given the seasonality, and in September, early September as well. But nonetheless, this week, there's nothing on the schedule today. But tomorrow, Tuesday, August 29th, we'll have consumer confidence, and we'll have the Case-Shiller Home Price Index and job openings. I mentioned job openings because, interestingly, when the Fed talks about the labor market, right, there's a sense that he feels, that Powell sometimes feels, that you've got to get the labor market slowing down in order to have demand from consumers to slow down as well, right? However, the labor market has been very resilient. But overall, the Fed, in their thinking and speaking, would probably prefer to see job openings come down more. And why is that important? It's important because the more the job openings pull back, the less people have a tendency to quit their jobs for another job to earn more money. In many ways, it gives the worker less leverage, right? And that is really what the Fed wants to see, particularly in an environment where you have quite a bit of potential strikes. Today, the concern is this week the United Auto Workers, but we've seen where, for example, pilots, the UPS, all of them, negotiating contracts where the possibility of strikes were quite evident, and the higher wages come in. And just to repeat myself, I say it every time, the concern about higher wages is that ultimately the companies that are paying the higher wages would like to just pass them along to the end buyer, whether it's retail buyers, whether it's small business owners, other large corporations. So we need to keep our eye on that. Then on Wednesday, and we will get the ADP employment report. Now, keep in mind, this is only the private sector. It does not include government. It does not have a really strong positive correlation with the numbers that we're going to get on Friday, which is the government report. The government report are surveys and includes government workers and private workers, but the ADP report is about the private sector. So we have to keep that in mind. We're going to get that on Wednesday. We'll also get a revision, perhaps, to the second quarter GDP. So far, consensus estimates indicate that it will stay where the number came in at 2.4%. But we'll see whether it's revised upward or even downward. We will also have pending home sales. And then on Thursday, this is key for the market, as it is for the Fed. It is the PCE report. That is the Personal Consumption Expenditure Index survey. And again, it will be core. We will look year over year. We'll look month over month. And obviously, it's important because it's important for the Fed. Now, granted, it looks back, correct? This is what happens. We always say that the Fed looks at old data. But nonetheless, what they try to do with the data looking back is to extrapolate and try to look ahead. And we'll also get personal incomes. Right now, consensus estimates suggest that personal incomes actually stay the same and that personal spending ticks up just a tad, We'll get those numbers. Friday, of course, is important, as we know, for the Fed. Wages are very important for the Fed for the reasons that I outlined. Payroll expected. Now, this is key. The consensus estimates has it at about 165,000 to about 170,000 new jobs, down from last month's 187,000 new jobs, and that the unemployment rate stays at 3.5%. Wages, the consensus estimates indicates perhaps down a little bit. But the hourly wages year over year expected to stay about the same at about 4.4%. And then also next week, this week on Friday, we'll get the ISM, Institute for Supply Management, manufacturing report. And we know that manufacturing is still in contraction. What we're looking for is to see if it is bottoming, because that's important. Remember, markets pay attention to any transition, either from strong expansion or contraction and turning the corner. And we will look to see whether or not we are bottoming in terms of manufacturing. And we'll look for new orders. We will look for prices paid. Very important, because again, if we continue to see prices climbing higher in the service sector or in manufacturing, it is an indication that prices are climbing back higher, where the Fed does not want to see that. Again, the reason is the concern that ultimately those higher prices will come in and force us, retail or business, to pay more. And that is not what the Fed wants to see. So in any event, it's going to be a very busy week. In terms of earnings, we're not finished. I mean, everyone says, oh, it's finished. It's not finished. I'll tell you what, I am looking for the earnings report for Best Buy. The reason I'm looking at Best Buy is simply this. I want to know about the consumer. Last quarter, Best Buy came in and said that they are noticing, yes, consumers are spending. Remember, those are typically kind of big ticket items, but they're being much more careful, much more deliberate. Let's see what they have to say about the consumer in the report that they have tomorrow. They're supposed to report before the market opens tomorrow. That's on Tuesday. It was interesting in Walmart's earnings report. Walmart made the case that, yes, consumers, actually high-end consumers as well, household incomes about $100,000, coming in and spending money on food. They obviously saw a big uptick. But what they added was this. They're starting to see consumers buying bigger ticket items. And for the company, obviously, that is higher margin. That's why they want to see them spending more in non-food items, products. So let's see what Best Buy has to say. It'll give us a picture of basically the strength of the consumer, the attitude of the consumer, and give us a little handle on the economy. So it's a busy week. We're still in the summer doldrums. But guess what? If August has been living up to its reputation as a difficult month in terms of seasonality and chop in the market, Friday is September 1st. So perhaps we move out of this range. One last thing here in the call, I want to mention China. China has come up over and over and over again as a cause for the markets to be down. The biggest concern in China is that they're having a problem with the financial system. That's, it's still only a problem. It's not a meltdown, but markets are worried. And it comes from the property developers, which is, by the way, about 25% of China's $18 trillion economy. They have their tentacles in all parts of the economy. So it isn't just a builder. It's much deeper than that. You still have them nearing default, bankruptcy, you name it. And at the same time, China has a very much entrenched shadow banking system. And within that system, there are a couple of banks that have basically halted payments to their customers, to their clients. That's something you do not want to see. And the worry is if this becomes a deeper problem, that perhaps there is a cascade or domino effect of defaults. So we're going to pay attention to that. China tried very hard to, underpin the market with confidence by cutting the trading tax that they had, and also lowered the margin ratios for leveraged trade. It helped a little bit, but when I'm looking at the overnight reports, the market is still choppy. Everyone knows that China wants to see the market calm down, but the prescriptions for it range from come in with a big fiscal package. That means not the central bank, but the government, Beijing, and do something to create more jobs, to create confidence. They seem to be loath to do that. Why? Because President Xi Jinping, is determined to break the cycle of debt that really built modern China. But we'll see, because at some point he may be forced to do it. If he does, it may be another infrastructure project. But keep in mind, and this is important, that they are doing very well in their buildup of electronic vehicles, the manufacturing of that, for batteries for electric vehicles, and also for solar. So they are prominent in those areas. And last but not least, the Secretary of Commerce from the United States is visiting, hoping to see if they can agree on some trading relations, building that up. And we'll see how she does, because it's been obviously a difficult relationship in terms of trade, as the Biden administration seeks to limit the amount of products that can go there in terms of silicon chips that can aid their military. So all of this is ongoing, but I wanted to mention that if China continues to deteriorate in terms of their their economic growth, it does have an effect on the trade relations with Europe, the trade relations with other emerging markets that have, long enjoyed deep trading relations with China. So all of this is, foremost in terms of the global economic backdrop. Have a good week. We'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.